Imagine you are at a farmer's market. You notice one stall selling beautiful, ripe strawberries for $5 a box. Just a few stalls down, another vendor is selling the exact same type of strawberries, also ripe and beautiful, but for only $3 a box. What would you do? If you are like most people, you would probably buy a bunch of boxes from the $3 stall, and maybe even sell some of them to people near the $5 stall for, say, $4 a box. This simple act of buying low in one place and selling high in another, taking advantage of a price difference for the same thing, is essentially what arbitrage is all about. In the world of finance and economics, arbitrage is a bit more sophisticated, but the core idea remains the same. It's about spotting and seizing opportunities to profit from price discrepancies. Think of it as finding a loophole in the market, a temporary mispricing, where you can buy something in one place and simultaneously sell it in another place for a higher price, locking in a risk-free profit. The key word here is risk-free, or very close to it. Arbitrage is not about speculation, which involves taking risks, hoping prices will move in your favor. Instead, arbitrage is about exploiting existing price differences to make a guaranteed gain. Let's consider a slightly more complex example in the stock market. Imagine a stock for a company, let's call it TechCo, is listed on two different stock exchanges, Exchange A and Exchange B. For some reason, perhaps due to a temporary imbalance in supply and demand on each exchange, the stock is trading at $100 on Exchange A, but $101 on Exchange. An arbitrageur, someone who engages in arbitrage, would notice this price difference. They would quickly buy shares of TechCo on Exchange A for $100 and simultaneously sell the same number of shares on Exchange B for $101. For every share they trade, they make a $1 profit. While $1 per share might not seem like much, when you are trading large volumes of shares, these small differences can add up to substantial profits. Arbitrage opportunities aren't limited to stocks across different exchanges. They can also arise in various other markets, including bonds, currencies, and even commodities like gold or oil. For instance, imagine the price of gold is higher in New York than it is in London, after accounting for exchange rates and transportation costs. An arbitrager could buy gold in London, ship it to New York, and sell it there, pocketing the difference. It's important to understand that these arbitrage opportunities are usually fleeting. As soon as arbitrageurs start to exploit these price differences, their actions themselves tend to eliminate the discrepancy. In our TechCo stock example, as arbitrageurs buy on Exchange A and sell on Exchange B, the increased demand on Exchange A will likely push the price up, while the increased supply on Exchange B will likely push the price down. This process will continue until the prices on both exchanges converge, effectively closing the arbitrage opportunity. This is why arbitrageurs need to be quick and efficient, acting rapidly to take advantage of these temporary mispricings before they disappear. While arbitrage might seem like a way to make easy money, it actually plays a crucial role in making markets more efficient. By constantly seeking out and exploiting price differences, arbitrageurs help to ensure that prices across different markets and for similar assets are aligned. They contribute to price discovery and market equilibrium, making markets fairer and more efficient for everyone. In essence, arbitrage is a force that keeps markets honest, ensuring that similar assets trade at similar prices, reflecting their true value. It's a clever strategy that highlights temporary inefficiencies and, in its execution, helps to correct them, benefiting the overall health and functioning of the financial system.